Carried interest loophole. You work 40 hours a week and pay taxes on every dollar. A private equity manager moves money around and pays half the rate you do on billions. Not because they found a secret hack, because the tax code was written with a door that only opens from their side. Carried interest is the share of profits that investment fund managers receive as compensation. When a private equity fund buys a company, restructures it, and sells it for more than they paid, the managers get typically 20% of the profit. This isn't salary, this isn't bonus. It's classified as investment return. And investment returns are taxed at capital gains rates, currently 20%, instead of income tax rates that go up to 37%. The mechanism is simple. Fund managers contribute minimal personal capital, usually 1 to 2% of the total fund. They raise the rest from pension funds, endowments, and wealthy individuals. When the fund profits, the managers claim their 20% cut isn't payment for work performed. It's return on their 1% investment. The IRS accepts this fiction. You pay 37% on your salary. They pay 20% on their billions. This isn't illegal. It's deliberately constructed. Lobbyists spent decades ensuring this loophole stayed open. Politicians from both parties have proposed closing it. None succeeded. The carried interest loophole persists because the people who benefit from it fund the campaigns of the people who could eliminate it. You can't access this strategy. You don't manage billion-dollar funds. You don't have accountants structuring your compensation as carried interest. The loophole exists in a space you'll never occupy. Private equity managers make more in a year than you'll make in your lifetime, and they pay a lower tax rate because the rules were written by people who wanted exactly that outcome. Borrowing against appreciated assets. You need money, you take out a loan and pay interest. Billionaires need money, they take out a loan and get richer. The difference isn't access to credit, it's understanding that debt is a tool for avoiding taxes while maintaining wealth. When you own stock worth $1 billion, you don't sell it to access that money. Selling triggers capital gains taxes. Instead, you walk into a private bank and use the stock as collateral for a loan. The bank gives you hundreds of millions in cash at interest rates around 2 to 4%. You spend that cash. You never pay taxes because you didn't sell anything. You just borrowed against what you own. This works because asset values generally increase faster than the loan interest. Your billion-dollar stock portfolio grows at 8% annually, while you pay 3% interest on the loan. The gap is profit. You're making money by borrowing money. When the loan comes due, you don't pay it back with your salary. You take out another loan against your now larger portfolio. The debt rolls forward forever. The strategy has a name: buy, borrow, die. You buy assets. You borrow against them to fund your lifestyle. You die with the debt still outstanding. Your heirs inherit the assets at their current value, which resets the cost basis and eliminates the unrealized capital gains. The taxes disappear. Your family gets the wealth without ever paying what you would have owed. You can't do this because banks won't lend you millions against stock you don't own. The minimum portfolio size for these arrangements is typically $25 million. Below that threshold, banks aren't interested. Above it, they compete to offer you money. The wealthy don't pay for their lives with income. They pay with debt secured by assets they'll never sell. Qualified small business stock exemption. You start a company and sell it for $10 million. You pay capital gains taxes on the profit, around $2 million gone. Your neighbor starts a company and sells it for $10 million. They pay zero taxes on the entire gain. The difference is Section 1202 of the tax code. Qualified small business stock allows founders and early investors to exclude up to $10 million in capital gains from federal taxes if they hold the stock for 5 years. The company must be a C corporation with less than $50 million in assets when the stock is issued. It must be an active business, not just holding investments. Meet these requirements, and your gain is tax-free. The mechanics are specific. You incorporate correctly from the start. You issue stock to yourself as founder. You wait 5 years, you sell for up to $10 million profit per founder. Zero federal taxes. Some states don't recognize the exemption, but most do. This single provision can save you millions if you structure correctly. Most founders don't know this exists. They incorporate as LLCs because that's simpler. They miss the 5-year window by taking on investors who dilute their stock. They sell before 5 years because they need money. They lose millions in avoidable taxes because nobody told them the rules before they started playing. The wealthy know about QSBS before they start their first company. Their accountants and lawyers structure everything properly from day one. They wait the full 5 years, even when earlier offers arrive. Tax strategy isn't something you think about after you succeed. It's something you build into the foundation. Real estate depreciation. You buy a rental property for $500,000. The building generates $50,000 in rental income every year. You claim the building is losing value, deduct that loss from your income, and pay almost no taxes on the rent. Then you sell the property for more than you paid. Depreciation is an accounting fiction that becomes tax reality. The IRS allows you to deduct the theoretical decline in your building's value over 27.5 years for residential property. You divide the building's value by 27.5 and deduct that amount annually. For a $500,000 building, that's roughly $18,000 in deductions every year. This deduction reduces your taxable rental income. Your $50,000 in rent minus $18,000 in depreciation means you only pay taxes on $32,000, but nothing actually depreciated. The building is probably worth more now than when you bought it. You're deducting a loss that doesn't exist while accumulating real gains you're not taxed on. The strategy scales infinitely. Buy 10 properties and you're deducting hundreds of thousands annually. Your rental income looks like break even on paper while cash flows into your accounts. Wealthy real estate investors often pay zero income taxes despite earning millions because their depreciation deductions exceed their income. When you sell, you owe depreciation recapture taxes. But you don't sell. You do a 1031 exchange, swapping your property for a larger one without triggering taxes. The depreciation continues on the new property. You repeat this your entire life. Then you die. Your heirs inherit at stepped-up basis. The taxes never come due. Family office tax arbitrage. You hire an accountant to do your taxes. They charge you $300 and file a standard return. A billionaire creates a family office that employs 20 professionals who spend all year finding ways to reduce the family's tax burden. A family office is a private company that manages a single family's wealth. It employs accountants, lawyers, investment managers, and tax strategists. The office itself is a business expense. Every salary paid to the staff is deductible. The office space, technology, travel for investment research, all deductible. The billionaire converts personal expenses into business deductions. The office coordinates complex strategies across multiple jurisdictions. They route income through entities in low-tax states. They time asset sales to years when other losses offset the gains. They use obscure provisions in tax law that only matter at extreme wealth levels. The minimum wealth to justify a family office is typically $30 million. Below that, the costs exceed the savings. Above it, the math flips dramatically. A family office costing $2 million annually can easily save $10 million in taxes. The return on investment is 500%. You file your taxes alone. They have teams working full-time to minimize their burden. You follow standard deductions. They create custom structures that exploit every ambiguity in the tax code. The law applies equally to everyone, but expertise becomes a weapon only the wealthy can afford. Private placement, life insurance. You invest $1 million and watch it grow. Every dividend, every capital gain gets taxed. A billionaire invests $100 million in the exact same assets and pays zero taxes ever. The difference is wrapping the investment in life insurance. Private placement. Life insurance is a custom insurance policy available only to accredited investors. You contribute millions into the policy. The insurance company invests that money according to your directions. The investments grow tax-free inside the policy. When you withdraw money, it comes out as a loan against the death benefit. Loans aren't taxable. This isn't normal life insurance. The death benefit is minimal, just enough to qualify as insurance under IRS rules. The policy is really an investment vehicle disguised as insurance. You control the investments inside it. Stocks, bonds, hedge funds, anything. The insurance wrapper makes all of it tax-free. The strategy requires millions in premiums. Insurance companies don't offer these policies to regular investors. The minimum is usually $5 million in investable assets. Below that, you're not worth their time. Above it, they'll build you a custom policy that functions as a permanent tax shelter. You pay 15 to 20% in capital gains taxes every time you sell. They pay zero. Over decades, this difference compounds into millions. The tax code gives them structures you're not allowed to access. Conservation easement donations. You donate cash to charity and deduct what you gave. A billionaire donates land they claim is worth $50 million, deducts the full value, and pays almost no taxes for years. The land cost them $2 million. They still own it. They just promised not to develop it. A conservation easement is a legal agreement restricting land development. You own 100 acres. You get it appraised as worth $50 million if developed. You donate the development rights to a conservation organization. You keep the land. You can still farm it. You just can't build subdivisions. The IRS lets you deduct the $50 million appraised value. The appraisals are often wildly inflated. Land worth $2 million gets appraised at $25 million by friendly appraisers. The conservation organization doesn't care because they're getting development rights for free. The IRS doesn't have resources to challenge most appraisals. This deduction can exceed your annual income. You carry the unused portion forward for 15 years, reducing your taxes to near zero. You bought land cheap in a rural area nobody wants to develop. You donated rights you were never going to use. You claimed a deduction worth 10 times what you paid. The IRS has tried to crack down on abusive conservation easements, But the basic strategy remains legal within deliberately vague guidelines. You donate $1,000 and reduce your taxes by $300. They donate land restrictions and eliminate millions. Opportunity zone deferral. You sell stock and make $1 million profit. You owe $200,000 in capital gains taxes. A developer sells stock and makes $1 million profit. They invest that profit in a designated poor neighborhood, pay zero taxes on the original gain, and potentially pay zero on all future gains. Opportunity zones were created in 2017 to encourage investment in economically distressed areas. If you sell an appreciated asset and invest the gain into a qualified opportunity fund within 180 days, you defer capital gains taxes. If you hold the investment for 10 years, all gains are tax-free forever. You make $1 million selling stock. Instead of paying $200,000 in taxes, you invest the full $1 million into an opportunity zone fund. The tax bill is deferred. If you hold for 10 years, all profit from the fund is tax-free. This converts tax payments into investment capital. You're investing money you would have lost to taxes. If the opportunity zone investment doubles, you've turned $1 million into $2 million, and you pay zero taxes on that second $1 million. The program benefits people with large capital gains to defer. If you're not selling appreciated assets worth hundreds of thousands, you have nothing to defer. The wealthy constantly sell businesses and properties. They're always generating gains they need to shelter. Grantor Retained Annuity Trust. You want to transfer wealth to your children without paying gift taxes. You create a trust, transfer $10 million into it, and receive payments back for 2 years. At the end, whatever's left goes to your children tax-free. If the assets grow faster than the IRS assumed, your children inherit millions without you paying gift taxes. The structure exploits the difference between actual returns and IRS assumed returns. The IRS uses a standard interest rate, currently around 5%, to calculate how much should come back to you. If your investments return 15%, the excess goes to your heirs tax-free. You put $10 million in stock into a 2-year grat. The IRS says you need to receive back $10.5 million. The stock grows to $15 million. You take your $10.5 million. $4.5 million transfers to your children without touching your gift exemption. The wealthy chain grats together constantly. They move hundreds of millions to the next generation this way. When someone dies with $1 billion estate, they often transfer twice that amount during life through grats. You can't use this because you don't have millions to put into trusts. Grats solve problems only the wealthy have, but those solutions save them tens of millions while your net worth wouldn't cover what they avoid. Backdoor Roth conversions. You're told you make too much to contribute to a Roth IRA. Your income exceeds the limit. A tech executive converts millions into Roth accounts every year despite earning exponentially more. The backdoor Roth strategy is simple. You contribute to a traditional IRA regardless of income limits. Then, you immediately convert that contribution to a Roth IRA. The conversion is taxable, but since the money hasn't grown, there's no gain to tax. This works at $6,000 annually for regular people. For executives and founders, it works at millions. When you exercise stock options, you can contribute shares to a traditional IRA at their current low value, then convert to Roth. If you're a founder with stock worth pennies that becomes worth thousands, you've moved millions into tax-free growth. The sophisticated version is the mega backdoor Roth. If your employer's 401k allows after-tax contributions and conversions, you can contribute up to $66,000 annually, then convert to Roth. Most people don't have this option. Executives do. You contribute $6,000 annually. They contribute hundreds of thousands. In 30 years, your Roth might be worth $1 million. Theirs is worth $100 million. Same account, different scale. They started with more.